Growing up in Singapore, the concept of investment never hit me until around my 20s, when I realized that many Singaporeans obsess over owning multiple properties. Because of passive income from renting out properties as well as a consistent track record of appreciating value in most towns, driven by high demand and a land scarcity. However, this is just one of many strategies to build wealth, and in our opinion, highly impractical for the majority of young adults. In this video, we will share 3 stock market alternatives which don't require massive capital to get started and still have the potential to consistently build wealth over the long term. Now, before we jump into the details, do note that I am not a licensed financial advisor, and none of this is financial advice. We're simply presenting our research and opinions for fun and educational purposes. To compare the performance of various investment strategies, we will assume dollar cost averaging the same amount to each of them and use the low end of estimates from historical performance to give a conservative estimate on the 10-year return on investment. We will then share the results, the pros and cons of each strategy, and then present our conclusion. Investment strategy number 1. Invest in a broad market index, which tracks a group of companies from a country. We will use 2 popular markets, the US S&P 500 and the Hang Seng Index, with a 50-50 split as an example. This will give us exposure to both economies of the West and the East via their largest publicly traded companies in market capitalization. Let's presume an investment of $500 in each index every month over the course of 10 years. To invest in each of these indexes, we can purchase shares in exchange-traded funds, also known as ETFs, with each share representing a tiny fraction of the underlying index. To buy into the S&P 500, we will use Fidelity's SPY ETF. To buy into Hang Seng Index, we will use BlackRock's iShares Core Hang Seng Index ETF. Speaking of ETFs, these days there are hundreds of different ones, which can give exposure to small-cap growth stocks, specific sectors such as tech, and even specific themes such as clean energy or water. We intend to cover ETFs in more detail in the future, so if this interests you, please like and subscribe to our channel to get notified when we release new videos. Now let's move on to investment strategy number 2. Investment strategy number 2. Invest in a basket of high-yield dividend-paying companies. The rationale behind this strategy is that such companies are typically cash flow positive, stable, and matured to the point where they have predictable growth rates. This type of investment favors boomer companies such as banks, utilities, and consumer non-cyclicals. These types of businesses may seem boring to newer investors who are perhaps chasing triple-digit ROIs and willing to bet on meme stocks or other speculative assets, hoping for their portfolios to go to the moon. To invest in high-yield dividend-paying companies, I will use BlackRock's iShares Core High Dividend Yield ETF for exposure to high-yield dividend-paying companies listed in the US, and Global X Hang Seng High Dividend Yield ETF for exposure to high-yield dividend-paying companies listed in Hong Kong. Similar to investment strategy number 1, we will assume $500 to each ETF every month. Investment strategy number 3. Invest in individual stocks. Now this is the trickiest to compare fairly, because hindsight is 20/20, and simply picking some of the mega cap stocks in either the New York Stock Exchange or the Hong Kong Stock Exchange would be extremely biased. Instead, we will use only the data that was available in 2011. Notice that amongst this list of 10 companies, 8 of them are no longer in the top 10. Let's assume we split our investment equally to the top 10 at the end of 2011. When I first added these companies to the investment calculation, I was pessimistic because 8 out of 10 companies dropping out in terms of relative market cap seem to imply overall underperformance, especially compared to the S&P 500, which had a strong reputation of providing at least 7% returns historically. So, if you had managed to split into parallel universes, each investing the same amount of money every month for 10 years, the you who chose investment strategy number 3 would have narrowly outperformed the you who chose investment strategy number 1. In real terms, the stock picking portfolio will be worth $195,000, or 63% higher than the invested amount. compared to the broad-based index portfolio, which would be worth $191,000 or 60% higher than the invested amount. And trailing far behind would be the high dividend yield portfolio, which would be worth $167,000, only 40% higher than the invested amount. Let's go through some of the pros and cons of each strategy. Strategy number 1, broad-based market investing, has a good balance of strong returns and low risk, in my opinion. However, if your goal is to generate passive income, the dividends, even after 10 years of investing, will not be enough to reach financial freedom. Strategy number 2, high dividend yield investing would have generated the most amount of passive income. After 10 years of investing, which is great if your intention is to use this passive income to pay for some of your bills. However, it also gave the poorest return on your portfolio value, around 20% less than other strategies. Strategy number 3, stock picking the mega cap company, had the highest returns because 2 of the companies, Apple and Microsoft, would have more than compensated for the poor performance of the other 8 that shared the top 10 list in 2011. This surprised me because it says that if just 1 out of 5 stock picks were excellent choices, you can outperform the general market. However, this comes with disproportionately more risk, especially if you had to decide ahead of time the stocks you were going to invest in for a long period of time. The best strategy, therefore, is a meta strategy. If you are still earning a stable income from your work, and depending on the amount of time you are committed to researching individual businesses, some combination of strategy 1 and 3 would be the best. If you are already close to financial freedom, and if you intend to use your dividends to pay the bills, you might want to transition into strategy number 2. Personally, I am lucky enough to have the spare time to research individual businesses, so stock picking is my usual choice. The unquantifiable advantage of stock picking is that it allows for a learning journey. When you are the one deciding how much to allocate into each business, regardless of whether it does well or not, you would have given yourself the opportunity to get better at investing by reviewing your decision-making process and refining it over time. This process is not suitable for everyone, however, so do consider carefully which investment strategies are suitable for you. Now, we'd love to hear your thoughts. Which investment strategy suits you best and why? Comment down below. If you're interested to join us on this financial journey, subscribe to our channel to get notified every time we release a new video. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you find this helpful, share this with friends and family. We will see you in the next video.